morning, clients and trading reps of Philips Securities. Welcome to today's morning call and webinar. Today we will be having an update on China's macroeconomics, the SGX, Ezra, and a US company called National Interstate. So I will bring you straight to the China slides, and my colleague Lin Sin will go through them.
Hello. Good morning, everyone. This is Lin Sin. So overall, we are optimistic on China's economy, on its improving fundamentals. So both PMIs are in expansion territory, though both moderated in March, but this is a good sign as China rotates to a more sustainable growth engine driven by domestic consumption. So 2014 growth target is set around 7.5% and is deemed flexible. Policy will focus towards reform and rebalancing the economy rather than growth, but also to support stable employment and at the same time provide support to investor confidence that reforms will be implemented in a stable growth environment. China has actually rolled out a mini stimulus package worth 500 billion yuan to boost its growth. Large stimulus like the one following the 2008 global financial crisis is unlikely, and Premier Li has indicated that short-term and strong stimulus policies will be limited to prevent temporary fluctuations in the economy. So moving to interest rates, the policy rate remains unchanged at 6% as the central bank maintains its proactive fiscal policy and prudent monetary policy stance. But the policy is likely to be tighter than last year. Money supply grew at 13.3% at the end of February, which is within the official forecast range. As for inflation, rose to 2.4% on year in March, which is also still within the full-year inflation target of 3.5%. This will provide plenty of headroom for policymakers to maneuver. For trade balance, both exports and imports were down in March, indicating a moderate internal and external demand. But trade balance reversed to a surplus in March, erasing some concerns after a deficit in February. We expect China's trade to pick up amid improving overseas prospects, especially economies of China's major trading partner, namely US and Europe, alongside with the weakened yuan. For exchange rate, China actually widened renminbi's daily trading band to plus or minus 2%. We expect higher volatility in medium term as China moves towards liberalizing its exchange policy. China devalued yuan on the back of weaker exports data and is expected to be temporary. Current account surplus, large FX reserves, net FDI inflows and net creditor position to the rest of the world provide fundamental support for the currency. Okay, so let's look at stock market. For Shanghai Composite, we can see that it's moving sideways as the Asia's largest economy shift gear. It's actually at a historical low valuation, trading at below its long-term average of -1 standard deviation of PB ratio. China also has recently announced to allow cross-market stock investment between the long-depressed Shanghai market and Hong Kong stock market. So this cross-border equity trading will help the development of both capital markets in Shanghai and Hong Kong. There are a few investment opportunities in this program, in this initiative. It will become a gateway. It will pose as a gateway for foreign investors to buy relatively cheap A-share stocks, and for China to attract more foreign funds, and mainland investors to have better access to Hong Kong's capital market. So we'll see dual listed stock price spreads to narrow over time. Okay. So what investors are actually concerned of are the key risks. which remains as a shadow banking industry as well as a sharp property market correction. So in the recent NPC annual meeting, China has actually set a timetable concerning the regulation over shadow banking, which shows that at least they are not in a state of debt denial. So China will develop a regulated regional borrowing mechanism, while the authorities have actually started a cleanup of the $6 trillion shadow banking industry and identified sectors of the economy in need of consolidation. And the recent first onshore bond default by Shanghai Chaoyi Solar Energy Science and Technology Company also signals Beijing's willingness, albeit tentative, to let some big companies fall. At the same time, fixing overcapacity is once again made priority. We expect the level of restructuring defaults to accelerate as companies sell assets and undertake mergers in a bid to pay off their debts in coming years. So over time, weaker companies will drop off. Winners remain in the market, will become stronger, and the market will be healthier. As for the local government debt, it's not the size of the government debt, but the growth rate of the debt that worries the investors. China's local government liabilities actually increased 67% over the 3 years. Generally, it's unsustainable for a country's local debt growth to continue outpace GDP growth. But in China's case, we have some mitigating factors. Most of the debts are actually domestic in nature. That is, China is indebted to locals, and thus credit risk is mostly confined to a domestic market. Meanwhile, with their capital controls, in other words, a relatively close capital account, creditors cannot take their money out of China without exchanging with other assets. Hence, a run is unlikely. As for property markets, Chinese new home price growth slowed in February amid tighter credit to rein in excessive borrowing and individual city measures to curb property prices. So China has actually taken a stance that it will take a differential approach to regulate the housing market and curb speculation and investment-oriented purchases via a subsidized housing program. Okay, just to recap the whole thing, reforms and rebalancing are pulling back growth rate, and growth rate remains compelling at above 7%, supported by positive macro, and optimism that new stimulus measures will help the economy to reach its 2014 target growth rate of 7.5%. Shadow banking system that fuels credit markets and real estate bubble remain the key risks, but we take comfort that the government is taking steps to get ahead of the situation. The stock market, Shanghai Composite sees a consensus earnings forecast growth of 26% year-on-year, which translates to a forward 8.23 times PE. Hence, with this earnings growth picking up and valuations are being low, coupled with improving macro fundamentals, we upgrade China to neutral weight from underweight. And on the slides also, we actually posted a few ETFs and mutual funds that proxy China. So for investors who are actually looking into other big markets other than US, Japan and Eurozone, which their markets have actually gone up very much. So you can consider buying China. Thank you. So now I will pass on to Benjamin.
Good morning, everyone. Benjamin here, your banking analyst. So today I'll be giving a short update on SGX because their results are coming out next week on the 23rd of April. So last week, SGX released their monthly statistics, right? So we evaluate on a quarter-to-quarter basis. So if you have been tracking the securities daily average value, which is we call SDAV for short, right? It's been shown to have some pretty down year-on-year for the last 1 or 2 quarters, right? So the positive thing is that the last quarter we saw a bit of a marginal recovery of 8.5% to about 1.08B.
So the previous quarter, 2Q, was ended off at about 1.02B, which is as of December 2013. Right, so on a year-to-year basis, for these 3Q figures, it's actually down 37.4%, right, because the market volumes have been pretty muted and it's quite weak. Right, so originally our forecast for the full year SDAV was about 1.3B, so the persistently lower than expected volumes for the securities market. Right, we have revised our full year forecast downwards to about 1.2B, right, which is quite in line with the consensus currently. Right, so the other key business will be the derivatives business. So currently it takes up about the same proportion with securities on a top line basis. So for the DDAV for short, right, quarter to quarter, yeah, yes, bounced back a bit as well, which is pretty positive. Right, on year to year basis, yes, went down a bit by 5.8%. Right, so for the derivatives portion, it continues to be driven by the 4 key contracts: your Nikkei 225, your Indian Nifty, China A50, yeah, and your MSCI Taiwan. Right, so we expect it to be recovering at a bit of a more gradual pace for the rest of this calendar year. But as for SDAV, we expect it to pick up right, in FY15 and FY16 right, when the market volumes are bounced back. Currently, for the last 2 quarters, it's actually about a 10-year low, right? So which is not very good news. Right, so we think that this is one of its lowest points. So we hope to see a bit of a recovery going forward. Okay, near-term wise, again, the correlation between the SDAV as well as SGX share price is very high. So near-term wise, the weak securities level will continue to pose a near-term headwind for SGX. But again, the derivatives business will continue to be a key growth driver right, for mid to long term as there are more and more contracts being offered, like from your ranging from your forex futures to your new Philippines and Thailand contracts. Right, so all in all, after we have revised our forecast, we have downgraded the call from buy to neutral and a revised target price of $6.89. So something to take note of is that previously mentioned that the clearing fees for securities right will be revised downwards from 4 basis points to 3.25 basis points. Previously, they mentioned that SGX mentioned that it will be effective sometime in May, so they delayed it to 1st of June 2014. Right, so for the retail side, which is contract values that are less than 1.5 million, you see a reduction from 4 basis points to 3.25 basis points. So I hope that this will help to stir up more market volume. But for the institutional trades, as we deem it above 1.5 million, originally it was capped at $600 a day. Right, so currently it will be revised to 3.25 as well. So previously, based on estimation, the effective clearing rate for the insti trade sizes was about 1.6 plus basis points. So it's actually close to 90% jump increase, right? So this could be a catalyst to higher securities revenue going forward. Right, so that's it for SGX. Pass on to Nick.
Good morning, clients. Today we have also published a report on Ezra Holdings. Ezra announced its 2Q result last Friday. The results is below expectation due to margins pressure. Its reported 2Q net profit is 19.6 million, down 34% year-on-year, but it's boosted by the 16.6 million one-off gain from sales and leaseback of its Louis Champion under the associate line. Adjusting for this one-off gain, core net profit is only about $3 million. Overall gross margin also decreased from 17.1% in 2Q last year to 15.9% this quarter, on the higher subsea contribution as well as the lower contribution from the offshore support margin, particularly due to the higher maintenance costs as well as lower utilization rate. For the subsea fundamentals, long-term wise, it's still remains robust, but we continue to see near-term headwinds due to the muted outlook from the oil companies as they are cutting down on the E&P spending. Hence, there will still continue. There will still be delays in the project awards coming down from the oil companies, and this should also impact subsea companies in the near term. We have cut our earnings estimates by 6 to 7% for FY 14 to 15 to factor in the first half results. We continue to remain neutral on Ezra, and our new target price for Ezra is 109. Any potential upside will come from substantial improvement in its subsea execution and hence higher profitability, as well as a stronger than expected new order wins going forward. Right now, we'll pass the mic to Yongkai, who will talk more on this undervalued stock, National Interstate.
Hi, this is Yongkai here, the US equities analyst. So we published a report on this National Interstate last Thursday, just a few days ago. You can actually go to our Poems platform and search for this. Okay, so a quick snapshot. The share price is $27, which is around the middle of the 52-week range. From the chart, you can actually see that the share price has been pretty volatile, spiking up and down in just the last 1 year alone. Market cap is around $540 million, and dividend is 48 cents. So after you factor in the 30% withholding tax rate, you're looking at probably about 1.3% dividend yield. So what this company does is actually a US property and casualty insurer set up in 1989. So the rating is A excellent by AM Best company. This is the third best rating that this gives. The gross premiums is $630 million in 2013, which is increased by about 13% compounded in the last 10 years. This track record is really excellent. In the last 10 years, it's also only had 1 year of underwriting loss, which coincidentally is only in 2013. So the risk is generally considered very short tail. That means that right after the policy expires or during it itself, then the claims are filed. So they know with pretty much high accuracy how much loss reserve they have to set aside. The New York Stock Exchange listed parent company, American Financial Group, or known as AFG, they own 51.7%. The founder and family owns 12.2%, and the investment manager owns T-Rowe Price, they own another 8%. So all in all, more than 70% of it, it's like around 70% is controlled by these three insiders. They're also very conservative, so they over-provision for lowest loss reserves in past 9 of 10 years, which actually buffers the balance sheet against the higher claims. One thing that we want to highlight, right, is that the parent company, AFG, which owns 51.7%, also provides actual services and review the adequacy. So what happens is that throughout 2013, last year, this NETL actually increased prior loss reserves by an unusually large provision of $23 million. So right after this provision was set in place, AFG offered, like 5 days later after the release of annual results, they offered to buy NETL for $30 per share. Multiple lawsuits were filed, and because of this, and because a federal judge granted a preliminary injunction, so they withdrew the offer. Okay, so for perspective, right, this $30 per share is actually 10% higher than today's share price. So this is a price floor that's been established already. Lastly, just a bit more background. They actually entered into agreement to purchase this Vanilla Insurance Co. in 2010. So they have a 4.5 years balance sheet guarantee agreement, which means that any P&L attributable to the loss reserves goes to Unigroup, the seller. This agreement expires in 2014, which means that after that, any favorable developments, which for the past 2 years has been $21 and $19 million, they will actually flow through to NETL. So if you actually adjust for the $23 million reserve strengthening, and also include the vendor's results going forward, its pre-tax income will have increased, will have tripled, all things held equal, held constant. Management also prepared 5-year projections where 2015 net income was $60 million. If true, that means that the company today trades at 9 times PE. Our target price is $42, which is around 56% higher than today. So this is a brief summary. This insurance company based in US. Premiums has increased by 13% since 2003. It's only in the last 10 years, this company only had 1 year of underwriting loss, and also over provision for loss reserves in the past past 9 out of 10 years. Insider ownership is roughly 70%, and the majority shareholder actually made a failed attempt to take over for $30 per share just 2 months ago. Lastly, the acquired company, Valender, had a $20.8 million favorable development, which means that losses were lower than estimated. So starting from next year onwards, this P&L can actually start flowing through to NATL, and the company will be trading at 9 times forward PE based on management 5-year projections. So we'll just go give a quick overview because our focus today is actually on the lawsuits, which highlighted many points of contention. So for the business, it's very geographically diversified across many states. Other than California, no one state accounts for more than 10% revenue. Most of the premiums are also transportation related. So in the last 10 years, as you can see from charts, they only had 1 year underwriting loss, which means that losses and LAE ratio plus expenses ratio is more than 100%. Okay, when it's more than 100% means that they actually incurred more expenses than the premiums collected. Because premiums also increased by around 13% compounded since 2003, but that's partly also attributable to the acquisition in 2010. If you look at the 5-year financial projections by the management, they project the loss ratio to be around 72%, which is in line with 2010 to 2011 and all the years before that, which we think is pretty much reasonable, given that the insurance market currently is they're actually increasing the premiums. The overall market is considered hard, which means that there's not much capital, not much surplus capital, and it's easier for the existing insurers to increase premiums. They also overprovision for loss reserves in the past 9 of 10 years. So you look at the blue line, which is the original estimates, and the 2003, which is the most recent estimates. The blue line is actually, the red line is consistently lower than the blue, okay, than the blue bar charts, which means that actual losses turn out to be lesser. Prior developments, usually they are also positive, ranging around $1 to $10 million, but starting from 2012 and especially last year, it gapped down to $23 million, which is an unusually large provision, which we think is quite suspicious. Okay, so of course the question is the company indeed undervalued? So we'll just refer you to the lawsuits, which actually alleges unfair offer price, flawed process, coercion, and inadequate disclosures when they launch a tender offer. So this is quite interesting because the majority shareholder has invested in this company since 1989 and 2005 IPO, and they've never bought or sold a single share. Yet today they are actually coming in and thinking of privatizing this subsidiary, which we think the renewed interest might indicate something. In all, 6 out of 10 of the current board of directors are affiliated with AFG, so which means that only 4 of the 10 are independents. Why? Okay, because Ohio has this interesting corporation law which provides for cumulative voting. So I think we are more familiar with the more common block voting, which means that if you have 100 shares, you can only vote 100 shares on each of the directors being up for election. Whereas for Ohio, if say you have 6 directors and you hold 100 shares, you can choose to concentrate all 600 votes onto one director and then you ignore the rest. So this increases the chance of success and explains how your minority shareholders has a 4 out of 10 representation on the boards. Actually, they are allowed to change this, but only if this provided articles of incorporation, which can only be amended by shareholders holding 66.7% stake, which compared to today, AFG, they only have 51.7%, which is still quite a distance away, and that is one of the reasons why they wanted to launch this tender offer to consolidate control. So one of the points of contention, inherent coercion. So on Feb 2014, AFG launched a tender offer, acquired the rest of the company for $28. They actually warned of possible consequences, the biggest of which is if they increase their ownership to a sufficient amount, they can actually have enough voting power to single-handedly amend the articles, and then in that case they can actually elect all 10 directors onto the boards. But the founder, Alan Speckman and his family, they own 12.2%. T-Rowe Price clients own another 8%, and both publicly committed that they will not tender. So because of that, they require more than half of the public float, and that was a very high hurdle which they didn't succeed. We also have a flawed process. So the 6 directors affiliated with AFG, they are obligated to refrain from decision-making process, but they fail to do so, and they also denied a request to form independent special committee. Instead, they hired Duff and Phelps. So in this case, because these directors are affiliated with AFG, they hired Duff and Phelps. I mean, usually you expect a positive outcome, right? But no, they came back with unfair opinions. Right away, AFG, which is represented by the company chairman, and AFG CFO, which is a purchaser, on the spot increased the offer price to $30. Okay, and it's also initially contingent that the board vote neutral on the recommendation. So I mean, people, you can imply, I mean, from what I see is probably that this $30 per share is probably not fair as well. But if they vote neutral, then they will get this $30 per share increase. Okay, last thing is during this board meeting, right after they voted for neutral recommendation, the chairman promptly adjourned the board meeting, even though they only met for 4 minutes, because I mean, he was also representing AFG as well, and he didn't really want to discuss much about discuss further merits. This point of contention is actually at the heart of our thesis. The management prepared 2 different copies of 5-year financial projections just one month apart, which even the directors were unaware of. The January projections were more optimistic and shared with the purchaser, but yet it's withheld from Duff and Phelps, which were only given the more conservative February projections, and NATO shareholders as well. Until only 2 weeks after the launch of tender offer, then all these exhibits were published on the SEC regulator. Again, Sparkman, he testified in court that he expected February projections to go up instead of down, as he now knew what January results were. So it is possible that this company outperformed even the optimistic January projections, which called for $66 million net income in 2015 versus today's market cap of $540 million. So this is just a chart of what's the differences. So by the time you reach 2018, you're actually looking at $100 million projection versus roughly today's, which we are looking at about 5.4 times PE if you're looking at 2018 results. Of course, we can say that maybe management is being overly optimistic. So in that case, we can actually, even if we base our valuations on the more conservative February projections, the company still trades at a forward multiple of 9 times PE next year's income. Okay, even then, the chairman also testified that he thought the assumptions were reasonable, 10 to 13% gross written premiums versus 30% compounded growth in the last 10 years, and 4.7% net investment yield is, when it reaches 2018, we expect interest rates to go higher, so that's entirely possible. Okay, so now we have a financial advisor which concluded that the company is worth between $30 to $36 per share, even based on the conservative projections. And then he said that you shouldn't take away from this meeting that the $30 offer will be deemed to be fair by Duff and Phelps. Even for Ernest Sparkman, based on the experience as the founder, CEO, and chairman, he does not believe the increased offer price reflects the fair value of the shares, and he wished that shareholders knew about some of the information he did not disclose. Okay, just for a quick perspective, this same guy divested a 3.1% stake at $30 in 2007. So 7 years later, I mean, you do have a bit of dividends, you do have a special dividend of $2 per share, but even then, the difference is between the book value and gross premiums is quite astounding. You're looking at 38% and 45%. So, I mean, it's not unreasonable to assume that 7 years later, the company could be worth a little more than $30 per share. Recall that they only had 1 year of underwriting loss, booking an unusually large provision in 2013. So the acquirer and the controlling shareholder actually provides actual services, which means that they can influence the company to increase provisions for loss reserves, which it did. So we think that it's equally more likely that a lot more loss provisions were recorded upfront than necessary. This depressed the earnings and share price, enabling a low takeover bid. So right after it released its preliminary 2013 results, AFG launched its takeover 5 days after. Even at 35% premium, the offer price is still below the 52-week high of $36. Of course, right over here, we're not saying that $36 is the fair price or not. We're just putting it into perspective that it's still below the $36 52-week high. Okay, so just some last few pointers. AFG decided that increasing the offer price will also make it possible to achieve its internal target threshold, which is minimally 11 to 12%. If Duff and Phelps formula were applied to these optimistic January projections instead, the shares could be worth $34 to $40. The insurance market currently is in the midst of in the hard market right now. So this actually gives all the insurers in the market leeway to increase the premium rates and also to discontinue unprofitable policies. So in this case, last year, they averaged 5 to 10% on most renewals, and they non-renewed $65 million on unprofitable policies, which is roughly 10% of gross premiums written. Even then, the gross premiums still increased by 14% year over year in the fourth quarter, even after factoring all the non-renewals. The vanilla results, as we discussed earlier, will be consolidated, and then you have a very overcapitalized balance sheet. Only $12 million long-term debt versus $350 million shareholders' equity, which is roughly 3 to 4% leverage ratio, overcapitalized. So valuations. Duff and Phelps, a financial advisor, actually supplied many of its own assumptions to arrive at fairness opinion. So you have 9 to 13% discount rate, 13 to 15 times of 2016 net income terminal multiple, and subject to approvals, the company could borrow $71 million to pay $4 per share extraordinary dividends, which is roughly works out to $80 million. So if we use the conservative February projections and also the highest discount rate and lowest terminal multiple, which is 13% and 13 times, factoring the dividend paid out, you should could be worth $42 today. Of course, investors might be skeptical and say that, hey, 2015, 2016, all these numbers are quite far down the road. So how about if I apply additional 10% haircuts for projections every year beyond 2014? Even then, it will be worth $35, which is 29% higher than today. To the very least, AFG offered $30 per share, and this is the point. This is the major point of contention. Okay, even this price, which is considered unfair, is still 10% higher than today. This establishes a price floor, so I don't think investors can actually expect minimal downsides. So in all, okay, normally yes, investors ought to actively avoid a company whose majority shareholder disregards minority interests, but a quote in the Ohio corporation law ensures minority shareholder representation, and you have two shareholders owning 20% stake, which is enough to block a lot of major corporate actions. Furthermore, AFG, the parent company, has historically treated minority shareholders fairly. So the company has actually consistently paid out dividends every year since 2005, and in 2012 actually paid out a $2 per share special dividends. So currently, even though we're just saying that it could be worth $35 to $42 based on conservative February projections, and the highest discount rate, lowest terminal multiple, upside could actually be higher if and when the market sees merit in adopting the more optimistic January projections. So the next few quarters we'll find out from there. Okay, so that's all we have for this company. Now we open the floor to Q&A. Thank you.
Hi, are there any questions for us regarding our coverage?
Hi, so one of the audience asked a question. Observed that NETL is trading on extremely low volume. Wouldn't this be a concern? Okay, depends on what you mean by low volume, because on normal days it's trading about $500,000 USD. Okay, so which I think is pretty decent for retail investors, and there's plenty of liquidity already. Also bear in mind that minority shareholders still have about 30% of public floats. So that is a cost. You can feel comfortable on that. Yeah.
There's a question on Ezra's subsea arm. Right. Currently, there isn't any news from the management yet, but they're still currently actively looking for ways to unlock the value. We will keep you guys updated whenever there is new updates in regards to its Ezra arm.
I had this question on Stats Chipek and Intera, whether you can take a long position. Unfortunately, we have no coverage on those stocks, and none of the analysts have actually looked into it yet. Sorry. Hi, there's a question on, besides using PMIs for China, do we use the Baltic Dry? No, we actually don't use the Baltic Dry. Actually, we've found it not to be a very reliable indicator because a lot of it is about the supply of capacity and rather than demand, unless it's very tight, then it becomes a bit more useful, but it doesn't have a good track record.
Okay, so we have another question on NETL. Why is such erratic trading price these 3 months? Yes, good observation. As we recall, the purchaser, AFG, actually launched a tender offer for NETL at 35% premium. So that was in February 2014, and you see the price spike up. Subsequently, they raised the offer price again to $30, so you see the price increase again. Then in mid-March 2014, just about 1 month ago, they withdrew the tender offer, which was when the price crashed around $27, has been around that level since. Okay, we have another question. On NETL, how did it come to my attention? Was there a screening or filter criterion? Okay, to be honest, I was actually looking for insurance companies, partly because they'll be the primary benefactor on the interest rate increase. And this happened to come to the radar because of all the corporate actions and there's a lot of articles about how the corporate governance, how the lawsuits were progressing. So that was how I looked further into NETL and saw that there could be a lot of substantial undervaluation there. That's right. So anyway, one of the audience wrote in saying that it's $21 in February, $30 in March, and down to $27 in April for NETL. Yeah, so again, they released the earnings. So 5 days after releasing the earnings in February, they launched a tender offer for at 35% premium, which is why the share price spiked from $21 to $30 literally overnight. And subsequently, it dropped to $27 because the tender offer was called off. And that's actually good for us because we are going to buy it at an even better price than what the majority shareholder wanted to offer. And I mean we also sort of established that there's probably 50% upside from today.
The question here on the US is undergoing correction, but the STI is defying gravity. Yeah, okay, so we have been guiding that, well, Kenneth has been guiding quite strongly that he expects that the US to undergo a correction this year, but it will be a less than 20% correction, and he guided that it will happen in the first half. And that pretty much has come to pass. But we also guided that it is quite likely that there will be a negative effect on the STI, but not as much. And I think we have seen that because in the past week or so, the STI has come off from its rebound in line with the correction, but not as much. And I think the chief reasons for that is that the STI had a flat year last year and is trading at extremely cheap valuation, about 12 to 13 times, whereas the US has had a 30% bull run already over the past year and is trading at very lofty 17 times earnings. Okay, our general thesis is that bull market conditions globally are still on. Okay, so but some markets, of course, will underperform and correct, and some markets may be going up instead. And I think what we're going to see is that more developed markets like the US, the Eurozone, Japan, all which have had very good runs already, are likely to come off, and markets which have underperformed like Singapore, China, have a higher chance to outperform.
Hi, Kenneth here. I just want to give a bit more about what Josh just said. At this point, the US has been correcting as per guidance for the last few months, actually. At this point, we have to look at the nature of the news. At this point, the US correction seems to be just based on the US market being overvalued. It's been very overvalued, and now we're having a technical correction. So at this point, the media has not, the nature of the media news is not that the US is correcting for global economic reasons, but rather just for its own valuations. So because of that, because we're still in a bull market, I suppose money needs to find another home, and it's possible for the short term for money to flow into Singapore market or even China market. That being said, if the US is going to continue to be weak for the next 2-3 months, right, which is possible, the media news could the media news could morph into something which is more global in nature, and that will probably affect STI and other markets as well. So that being said, at this point, I will still probably have a trading mentality. Okay, now for the STI itself, technically speaking, the price has broken out of an intermediate pattern and is right now trying quite hard to stay above it. So right now the support is 31.85. So that's the support. Now if I will look at it, and if price breaks down 31.85, you can expect a short-term move to 31.40. The reason why I'm talking about support and resistances is because I feel that we need to have a trading mentality in the STI still. So if price breaks below 31.85, it will most likely go to 31.40. Now, if price actually breaks out of 32.20, right, that will confirm a further upside move that can be higher, okay, to even 33.60. So I would take a trading mentality and probably go contrarian. So if expectations get too lofty, I would sell, and if price gets oversold, I would buy. And this is the reason. And the reason is because of bull market conditions still being on.
Hello, this is Lin Xin, the Chinese, the macroeconomist. So there's a question on whether the three funds is mentioned earlier is are our house top fund picks. Actually, yes, for China market. So basically, we look into the first the 1 year, 3 years returns as well as the volatility as well as the expense ratio. So qualitative-wise, these three funds actually obtain a 5-star overall Morningstar ratings. So yes, these three funds are actually our top fund picks. Previously, yes.
There's a question on what are the best sectors to get into. Currently, I think sector-wise, STI is not a great it's not a great market to play a sector rotation game. However, we run a top picks stock strategy instead. So on our top picks, we have not changed them since we last reported in late March, which is basically Balstead as a top pick, First Resources, Pan United, M1 and Silver Lake. You can go back to the 24th March presentation and the reasons are put there. Or you can go into Poems and look for the reports. We have gone through these topics quite a few times already. Okay, thank you. Oh, question on China banks. Okay, we don't actually cover Chinese banks from Singapore. So if you could send us an email, and then we will put you in touch with our Chinese analysts who cover the banks out of Hong Kong. Okay? Okay, thank you so much for logging in, and we very much appreciate all your attendance. Keeps us going, and we look very much to presenting to you guys again next Monday. Thank you so much.